Well, from property to shares, when it comes to growing your money, knowing where to put your hard-earned savings can be confusing.
And for some people, that's enough to put them off completely. Currently, less than half of Australians, about 48%, are investing, with many not knowing where to begin.
So to break it all down for us, we're joined by personal finance content creator Ravi Sharma. Morning to you. Time's obviously very tough for Aussies right now, so everyone wants to make sure they're making the most of their money. First up, investing in property, pros and cons.
Yeah, to summarise, I guess, really quickly, it's property gives you leverage. So it means with a small deposit, you can control a bigger asset. Apart from that, you've got tax benefits. So if you're negatively cash flowed or negatively geared, you can claim some of that back in your taxes. And then, of course, you can use the equity in one property, be it your home or investment property, to go and purchase more properties.
Equity is so powerful.
Oh, definitely. Yeah. But it really comes down to your borrowing capacity. And as we know, interest rates are so high. So when we're looking at the cons, it is getting quite difficult when interest rates go up and you haven't budgeted for that. It can get quite hard on your budget as well at home, and then you've got issues with tenants that could potentially come up, and of course you've got to put a lot of research in, otherwise you might make the wrong property choice.
Or property can go down.
Correct.
Exactly.
Yeah.
Shares are good but daunting. What's your advice?
Yeah, look, I think it's become so much easier now to purchase shares. There's numerous apps out there, micro investing and things like that. So it's not as hard as it used to be. But in saying that, you know, the pro with it is that you can go in today, purchase, and if you wanted to, you could sell it and get your cash back by the end of the week. You don't really get that with property. You've got to wait 6 weeks at least to try and sell it with an agent and things like that. But with something like shares, you've got at least that accessibility, which makes it a lot easier. But it's also a con, because you might decide, hey, at night time, it's the market's crashing, I'm getting a little scared, I might sell, and you might sell at the low and unfortunately lose some money.
Everyone's got a tip too. I mean, who do you listen to? That's the trouble. Yeah. There's always, I can tell you, there's always someone in WA with a mining tip.
Exactly, yeah, there is. And get advice, though. That's the most important part. Just absolutely get advice.
Yeah.
But are you noticing a shift in demographics? Is there a section of Australians that are going, look, the housing market's way too hot, I'm never going to get into it, so that's gone for me, I'm going to get into shares? Is that, and the way apps are used these days, it's much more accessible, it's easier, you don't have to go through brokers and pay all the fees.
Yeah, definitely.
Is it a shift?
Yeah, definitely, because with property prices being so high, your deposit needs to be higher, and suddenly people are going, it's so out of reach, let me start using those investing muscles with something smaller, and that might be a couple of $100 in your bank account, or it could be a little bit more than that. But if you were to start, you're sort of going, let's build a base with the foundation, and then if you do decide to go into property later, you can use leverage and all the good stuff that comes with it.
Okay, so what's your verdict? How do you work out what the best thing is to do?
Yeah, look, I think it really comes down to people's risk appetite. You know, going into property can sound all sexy and it's great, but you've also taking on debt and a large amount of it. So I think for me personally, it works well when you've understood the foundations of what you're trying to do, your big vision and your big goal, but it really does come down to your investing thesis and I guess your risk appetite long term.
Yeah, but shares can be risky too. That's a roller coaster. So
yeah, most definitely. Yeah. And I think it's, you know, when you look at your mortgage, it's almost like a forced savings, whereas with shares, you can go in and, again, because you can go in and sell really quickly, unfortunately, people do end up losing money because it's a lot more volatile than, say, something like property.
Okay. Volatile is the key word at the moment, isn't it? On every front.
Thank you, Ravi.